My voice is a bit tired, so I guess I use it. So the first thing I wanted to say is that actually I went a bit fast this morning. I thought it would take me 2 hours to present the model I presented this morning because I wanted also to introduce the basic models, which is behind all behind that, which is a very simple cash management model that was developed independently by Radner and Shep and Jean-Blanc Piquet and Chirieff 20 or 30 years ago. And I find it a very useful model to describe banks, because the usual model of corporate default, the sort of workhorse of corporate finance, is the Leland-Merton type of models where there are actually no cost of issuing new securities, and therefore firms typically don't keep cash reserves, and they default voluntarily. And I believe this is a very bad model of banks, because banks typically default not because they're insolvent, but because they are illiquid, and therefore the liquidity management model that I used this morning is, I think, a very good workhorse for studying banks, in particular bank default. So I had initially planned to develop for some of the students among you these basic models, but I'm open to, I will be here also tomorrow, so if you want to ask me questions about that, I'm very open to that. But this afternoon I will present something that I'm doing with Hans Gersbach from ETH Zurich, and it's really the same type of approach, trying to develop simple and the simplest possible models of banking in order to study the question of financial stability. So it's not for monetary policy, it's for financial stability. And so here I will focus on one particular aspect. Tomorrow I will focus on other aspects which have more to do with the impact of bank capital on growth. Here it's really the impact of bank capital, and in particular regulation of capital, on fluctuations, okay, on credit fluctuations. And so the motivation is really basic. That is, as you know, after the crisis, new regulatory authorities have been created. Some of them are within the central bank, some of them are independent from the central banks, but they are developing new tools, and among those new tools, which are motivated by what is called macroprudential regulation, which is the notion that you want to preserve the stability of the financial system as a whole, and this is very different from the traditional motivation for banking regulation that was microprudential regulation. In other words, you want to preserve the stability of individual banks. Okay, so the type of thing that I'm talking about is really concrete in the sense that some countries, including Switzerland, have already implemented those measures. So I will explain what it means, but basically the idea is that you want to require banks. So I don't know if you follow the controversy about bank capital. There is this interesting book by Almaty and Helvig, and there are many discussion papers that criticize their views, but I mean, it's an interesting debate. So basically the idea, to simplify, the idea of microprudential regulation is to say, well, let's require that banks have sufficient capital to absorb losses in such a way that the probability of individual failures is reduced. Okay? But then, on top of that, some countries, including Switzerland, have adopted, and the Basel Committee is also thinking of doing that, but Basel Committee typically takes 10 years to implement their measures, so we still have but the Swiss are more prompt. I mean, they already implemented it and activated it, actually. So the idea is to require more capital when things go well, which if you think of it for a moment, it's a bit strange. Because if capital is there as a buffer, as they call it, to absorb losses, and it's very often a confusion between reserves, which are on the asset side of the balance sheet, and capital, which is on the liability side. Sometimes the idea are not very clear about the distinction between the two. But anyway, the idea normally would be to say, if things go badly, the probability of default of borrowers is higher, so you want to have more capital. If you want to maintain basically the same probability of default in a value at risk framework, for example, you would require more capital when things go badly and less capital when things go well. So it's pro-cyclical. There is a natural pro-cyclicality of capital requirements. But here you want to do the opposite. And when you look at the regulatory literature, it's not very clear what they intend to do. And in fact, I think they intend to do two different things. One is really to, make the financial system more resilient. So it's basically the generalization of the macroprudential objective. Instead of saying we want to limit the probability of individual failure, we want to limit the probability of banking crisis. And so basically the same logic. But then it wouldn't go like that. You would require less capital when things go well, if it was the main justification. And there is a second justification, which is related to the presumption that banks tend to lend too much during booms and too little during downturns, and therefore you generate what is called credit cycles, which was, by the way, the title of the paper of Kiyotaki and Moore I discussed this morning. So the notion that there are two big fluctuations of credit, and this is detrimental to the economy, and you want to limit those excessive fluctuations. So in particular, in the data, so I like this particular figure because in this particular period, 1970-2000 in the US, this represents the business cycle fluctuations, if you like, in gray, and the credit cycle fluctuation, the variation of a bank credit. And what you see is that they are perfectly synchronous, which is of course not always the case. In particular, in other countries, it's less. In the US, it seems that the banking cycle, the credit cycles, and the business cycle are very correlated. In other countries, it's less so. But what is interesting here is that the credit cycles are more pronounced, or more volatile. And the synchronicity is not robust, but the fact that the banking credit cycles are more volatile, bank credit is more volatile than GDP, is something very robust. For example, May and Moran, on a different time period in the US, finds that basically the standard deviation of bank lending is almost 5 times bigger than GDP, which is even bigger than on this picture. In other countries, and this is there is a very interesting data set by Schuleric and Taylor on a long period, or more than about 60 years, for many countries. So they show again that the fluctuations, also here the color has changed, so in black it's the GDP and in gray it's credit. And so you see that in all countries, with different degrees of course, but in all countries, bank credit fluctuates more than GDP. Well, it's not necessarily a bad thing. We need a welfare analysis in order to prove that there is something wrong with that. But it's a fact. So what we're going to do in this paper is try to find the simplest possible model that generates these credit fluctuations. And in this model, it will turn out that there is indeed a conceptual foundation for this countercyclical capital ratio. We show that under certain conditions, countercyclical capital ratio indeed improve welfare. So it's a little bit like the discussion of how monetary policy, or more accurately, fiscal policy can limit business cycle fluctuation. There was this controversy I mentioned this morning with Lucas and others. So here we're talking of credit cycle fluctuations. Is it a good idea to try to limit fluctuations of credit? And we in our model, this conceptual foundation, there is a market failure, if you like, is the result of the interplay of 3 ingredients which we believe characterize modern banks. And you need the 3. I mean, if you take out one, it doesn't work. One is the endogenous leverage constraint, and the fact that banks are typically constrained both in booms and downturns, which is not necessarily the case for other borrowers. The other is the high exposure to aggregate shocks, in the sense that banks all the banks basically lend to the economy, to the firms and to the households, and therefore they're exposed to the same shocks. And finally, a bit surprisingly, The fact that banks have access to derivative instruments, the fact that you could say that financial markets are almost complete for banks, paradoxically contributes to exacerbating fluctuations. In other words, in a model where you will have limited access to financial markets, let me rephrase. In other model of fluctuations, of financial fluctuations, if you have complete markets, those fluctuations disappear. Here it's not the opposite really, but it is in other words, complete markets do not contribute to the stabilization. Yes, you had a question.
Are you calling these externalities?
Yes, there will be.
None of these are externalities.
Sorry?
To me, none of these are externalities.
Sorry, I don't get it.
Did you call these externalities?
Not yet, but I will.
Refer to externalities.
I will very soon talk of pecuniary externality.
Externalities.
Oh, excuse me. Sorry for that. Okay, so from a point of view of regulatory implications, I believe that it's relatively interesting because one important issue when you have independent regulators that is endowed of strong powers, which is an ideal that is not unfortunately not attained anywhere, but suppose you have a real independent supervisor or regulator, then of course you need accountability. You need to be able to check that the regulator is doing his job or the supervisor is doing his job. And for that you need a clear mandate. If the mandate is to limit the probability of banking crisis, that would be very difficult to assess, because how do you measure the probability of a banking crisis? Normally you don't have banking crisis for 20 years or 25 years, hopefully. So how do you assess the performance of the regulator? It reminds me when I started to work on systemic risk a long time ago, people were questioning, is there such a thing as systemic risk? We have never seen any systemic crisis. And the regulator was saying, well, it's because we do our jobs, so there is no systemic risk. But now we have seen systemic risk. So anyway, so the idea is that instead of telling the regulators they have to prevent the probability of a banking crisis to be too big, and nobody can check that they are doing their jobs unless there is a crisis, I believe the notion would be to give them a measurable objective, which is to stabilize credit growth. I don't want to go into the practical implementation because there is a debate among empiricists of which measure of credit is best, what are the correct threshold for intervention. I don't want to go into that, but it's just a principle saying that if the regulator is in charge of avoiding excessive of limiting excessive fluctuations of credit to GDP, let's say, then it's easier to evaluate. The performance of a regulator is easier to evaluate, and therefore maybe it will be easier to convince politicians to relinquish their powers to independent regulatory agencies, which I believe is a good model.
Do you think that's easier to measure? Because one way of stabilizing credit growth is to stop credit growth, but nobody would.
No. I'm not saying that. One way to stabilize the banking sector is to close down all the banks. That's for sure. But I don't believe. I think you have to be a bit more subtle than that.
But that's because when you show your cycles, you're implying that the volatility of the credit cycle is excessive because you benchmark it to the GDP. But you can also consider that the credit is generating.
No, sure, but I will.
So, is there a causality?
Can you wait for at the end of the presentation? I hope you will be convinced that there is indeed a market failure, and you can increase welfare if you reduce the volatility of credit. But I'll come back to that later. For the moment, I'm just saying what is a practical way to give a mandate to the regulator, and I'm just saying that assessing the probability of default or probability of a banking crisis is impossible because people will come up with different models and there will be no agreement. If you give the mission, the mandate to just avoid fluctuations, for example, in a certain threshold of credit to GDP, for example, then this is observable. This is not what I'm saying. This is something you can check. It's a bit like monetary policy. if you give a mandate which is to limit inflation, CPI inflation to 2%, that's something you can check. Anybody can check that the central bank has done its job or not. Okay? If you give more complex agendas or mandates, it's more complicated to check. That's all I'm saying. The other thing I wanted to say is that if you look at the regulatory literature, and there are citations, for example, in the BIS documents, the notion is that you want to encourage banks to build buffers in good times so that they can draw on those buffers in bad times, which is I find very strange, because to me it means that there is implicitly a negative autocorrelation of returns. If things go well today, necessarily tomorrow it will be bad. So we have to save for the rainy days or something like that, which I find very strange. Here we will show that even if there is the notion in particular is related to the Minsky type of things that have become fashionable again, namely the view that bankers are over-optimistic. When things go well, they start speculating like mad, and then when there is a change when there's a negative shock, poof, there's a huge losses and these kind of things. So in our model, we don't need any kind of irrationality of investors, and we don't need also the type of property that Fari and Tirol have analyzed, which is the notion that if bankers anticipate they will be bailed out in case of a crisis, then they will take excessive risk, which is a standard thing. And of course, I'm not discarding this kind of explanation. I think there is some truth in both, but I'm saying that we don't need those things to justify interventions in the limitation of credit growth.
Yep. I'm not sure why you find it strange to build a buffer when there's during the up phase of the cycle, because if you think about it, like the capital requirements now are based on backward-looking.
No. I'm not. I agree with you.
Just to correct the backward-looking feature.
No. This is entirely consistent with what I'm going to say, but it's the notion that if things go well today, it's very likely that they will go badly tomorrow. These kind of things, which I find a bit strange, because maybe the economy will grow for 20 years, so we have time to build. The reason why you want to limit credit today is just to be protected in 10 years' time. Is that what? I mean, that's very strange.
No, but the timing is random. You don't know when.
No, sure, but I mean, normally generalized banking crisis only happens every 25 years. So why imposing restriction? And this is also the view that I would like to defend. For me, those instruments are really a way to control the volume of activity of the banks. It's not the way to control the buffers. Here, equity in our model will be really what determines the volume of activity of banks. Okay, so of course it's related to the literature I was mentioning this morning, Bernanke, Gertler, Kiyotaki and Moore, and actually there is let me mention in passing that when fluctuations, and this is really the debt deflation story a la Fisher, that is when things go badly, the value of the collateral, the assets of the firm decrease, and therefore firms are restricted, they cannot borrow as much, and therefore they cannot invest, and there is an amplifying phenomenon, a kind of vicious circle. You go into a debt deflation, and this goes through the price of collateral. But Krishnamurti has pointed out that if you have complete markets, and you can insure against the fluctuation of collateral prices, those fluctuations disappear completely. So you need incomplete markets. But there are papers, interesting papers, Bianchi and Korinek, for example, that use a Kiyotaki-Moore type of model, where collateral determines the capacity, the value of your collateral determines how much you can borrow. And those papers show that they have pecuniary externalities. And so pecuniary externalities are situations where the actions of some economic agents, here it will be the banks, have an impact on the prices of some assets, here a credit or collateral. And this in turn has an impact on the economy, which is not internalized by the banks. So we'll have exactly the same phenomenon, but I claim that it's much simpler than the story that they have, which is quite complicated. In fact, there are 3 papers that are closely related to what I'm going to present today. One is the paper by Holmstrom and Tirol, where you have a double moral hazard between banks, between investors, banks, and firms, and therefore the net worth of the firm and the net worth of the bank has an impact on the equilibrium values of activity of credit, investment, and output. So it's similar, except that we have a real macro model with macro shocks, and we have. I realize it's sorry, I took the wrong version. Excuse me for a sec. I took a previous version of the slides. No, it's just that it's more. Okay, so I hope this is one. Yeah, sorry. So the difference with the model of Tirol is that really we have macro shocks. There is also a very influential paper of Lorenzoni called Inefficient Credit Booms, which uses basically a Kiyotaki and Moore type of framework to explain that there are periods in which banks lend too much, and that's very inefficient, and this is related to the to also another form of externality. But the difference with the Lorenzoni model is that we simplify everything. First, we have complete markets, whereas in Lorenzoni, if you have complete markets, the effect disappears. And we also have simpler modeling of financial friction. And finally, we have a companion paper with Garsbach, where we model investment externalities, but the difference is that we introduce complete markets and we neglect adjustment cost that complicates the story. Okay? So again, a little bit of criticism of the DSG models. Of course, some people have tried to use DSG models and incorporate banking sector and frictions in them. So there are quite a few. These are interesting papers, but I believe they are more targeted to monetary policy rather than financial stability. And in any case, they rely on simulations. And so basically the message I would like to convey at a very superficial level is that the models for financial stability have to be simple enough so that your politicians or regulators can understand what's going on. If you have to rely on simulation and nobody understands the role of such and such parameters, I don't think you will be able to convince politicians. Maybe I should illustrate that by a concrete example. So I said in Switzerland, they were the first to adopt in the law this countercyclical buffer. And not only that, but they were the first to activate it because at the end of 2013, they thought, the Swiss National Bank thought that there was a bubble going on in the real estate market. So they really wanted to compress prices in the real estate market. So the BNS, the Swiss National Bank, came to the government and said, we have to implement it, we have to activate it. Of course, the regulators, the microprudential regulators, FINMA, didn't want. They were opposed to it, and this is a very classical pattern. This is a conflict between microprudential and macroprudential objective. It's very often the case that the objectives are conflicting. And so the government had to decide, should we follow the advice of the Swiss National Bank or should we follow the advice of the microprudential regulators? And they decided to follow the Swiss National Bank. And the reason is that there was a clear mechanism. They were talking of this real estate bubble. And the point I'm trying to make is that if you use a DSG model to convince the government that they should take a restrictive measure that could be unpopular before a general election, these kind of things, I don't think you will be successful. You need to have a simple thing that they can communicate to the media, they can explain. If it's, oh, my DSG model told me that if I use this set of parameters, I got this, I don't think you will be able to communicate this. Okay, so let us talk of the model. Simplest possible model in which bank capital matters. Okay, so it's maybe we call it a partial equilibrium, partial deterministic static equilibrium. Okay, so it's really simple. So for the moment there is only one period, 2 dates, 1 and 2. You have two goods, capital and consumption. Capital good has a total, it's normalized. The total endowment is fixed and normalized to 1. And then you have to decide how to invest this capital good in order to produce consumption at day 2. All agents are risk neutral, they consume only at day 2, and so social welfare is really the same as aggregate output. You want to maximize aggregate output or expected aggregate output. We have 3 types of agents. All of them are competitive, so this is why we use this continuum of agents setup. Bankers, they are characterized by their individual wealth, small e, but you have to think of it as equity, or I should say inside equity, to be more precise. But since the model will be easy to aggregate, it will be a linear model, what will matter ultimately will be the total capitalization of the banking sector. This will be the crucial state variable, if you like. So the rest of the capital is owned by the investors, and you also have entrepreneurs, but they only play a passive role in this model. So again, it's a very simplistic model. But as you will see, it's quite rich. So we have 2 sectors. You have the large and established firms that directly finance themselves by issuing bonds, for example, on the financial markets. So there are no frictions, and those firms can be aggregated by certain aggregate production function f of x, where x is basically the size of the bond market, how much capital is allocated to those firms by the financial market. And you have small or new or opaque firms that cannot issue directly securities on the financial market and have to use banks. So banks are there to monitor those small or opaque firms, and the banks themselves are subject to a potential more hazard problem. So you have to give incentives to the monitor to do his job. So the notation, so the total amount of credit will be capital K, and again, the typical bank will lend a small k. So x, the size of the bond market, will be by construction 1 minus k, because the total amount of capital. So it's a real model, so there is no money. So real model, you allocate real capital, and you have to decide to which sector you give it. And so basically, let me maybe show you. Can you see if I write here? I'm not sure. But I mean, it's a very simple story. You have here you have basically the investors or the depositors, if you want. You have the banks. So the total amount of capital of the economy is 1. So banks have or maybe I should show it to you on this. It will be more. Yeah. So this is the typical balance sheet of a bank. So the bank has 2 sources of financing. One is equity, and the other are deposits. But here I'm talking of wholesale deposits. I'm not talking of retail deposits. I don't want to study the microprudential objective. So I neglect deposit insurance, this kind of things. I'm looking at wholesale market deposits that in principle are not insured. And the total volume of credit for the given bank is K, okay? And so the only friction that we have is that the banker must get at least a payment of BK, which is proportional to the size of the assets it manages. So if the banker lends K, necessarily the return that is promised to the banker must be at least BK, otherwise the bankers do not do their job, they do not monitor their borrowers. And so it's related to the notion of pledgeable income that was introduced by Holmstrom and Tirol and others, which is the notion that even though the total return on assets, which for the moment is deterministic, RK, which is proportional to the size, it's a constant returns to scale. The total return is not pledgeable to investors. Investors get only R minus B, K, okay? So that's the only friction. Everything else is efficient. So there are several ways to justify this friction. I was thinking more of the more hazard aspect, where banks have to have a sufficient skin in the game, sufficient stake in order to monitor, to incur the cost of monitoring. But in fact, it turns out that other types of imperfections like limited commitment of the future return or asset diversion, these kind of things, which are used in the other models that I just mentioned. It would work also equally. So the crucial thing is that you have a total return RK, but you can only pledge R minus BK to investors, to depositors. Okay, so to wrap up, we have two sectors, large and transparent firm in sector F, which are aggregated in this concave production function f of x. They can be financed directly by investors. By contrast, you have small and opaque firm in sector B, which are financed by banks, but banks themselves must be given incentive to monitor those firms. And this moral hazard problem limits the lending capacity of each bank to a multiple of its own wealth. How do we see that? Simply by looking at the balance sheet of the bank here. So you know that the return to bankers must be at least BK. And since it's proportional to the size of the bank, the coefficient B here is a parameter that measures the intensity of financial frictions. If B was 0, there would be no problem, no inefficiency. The bigger B, the less efficient the system. And the depositors or investors only get this amount. So depositors here are wholesale investors, and they have the choice between investing in banks or investing in the bond market. So the return on the bond market is given by the marginal productivity of the firm in the other sector. So this is the equation that determines the relation between the supply of capital to the banking sector and the price. The more capital you require, the higher the price. So here P should be interpreted as a bit like a rental rate, like that this morning, is how many units of the consumption good do you have to promise to the investors in order for them to lend you 1 unit of capital. Okay, so it's the price of capital in a certain sense. The important thing is that for investors to accept to put their money in the bank, the rate of return they should get, which is this, namely the maximum amount they can get divided by the volume of deposits. This must be at least what they get in the bond market. In fact, at equilibrium, it would be an equality. Okay, so the rate of return on deposits must be equal, or at least or greater than the rate of return on the bond market. And this, if you rewrite it, you see that it's equivalent to a leverage constraint. Because if you transform it, it's equivalent to this. The ratio of equity over total assets has to be at least equal to this number here, which can be interpreted as a market-imposed capital ratio. So at this stage, there are no regulators. It's just that investors, they are not ready to lend any amount to the bank. They just give a certain multiple of their equity, and this multiple is endogenous. It depends on, in particular, the price of capital, which will be determined at equilibrium. Okay, that's the main thing. The leverage constraint of the banks depends on the price of capital, which will be determined at equilibrium. So each bank will maximize leverage here. It's a very simple behavior. They want to be as big as possible because the returns, the dividends are proportional to the size, so they want to be as big as possible. And they are only limited by the constraint imposed by the investors. Investors don't want to lend them more than this amount, so it means that the capital ratio is binding at the level of each bank, and therefore it's also binding at the level of the economy. So the total amount of bank credit in our model will be a multiple of the equity, the capitalization of the banking sector, and this multiple depends on these parameters. Particularly, it's increasing in E. The more bank capital, the higher the volume of credit. It's increasing in R. The higher the return on assets, the more credit. It's decreasing in B, which is the parameter that measures the intensity of friction. The bigger the friction, the less the volume of credit to the economy. So I call that, by analogy, a demand function of the banks. Okay, so the higher P, the more capital they demand. Yes, the less capital they demand. Sorry.
So I'm going to think about externalities here. So I don't think of moral hazard as like an externality in a traditional sense.
No.
But it seems to me that if it were a moral hazard problem, B would be a cost to the banker, but you've got it as income to the banker. So it looks to me like the way to interpret B is a cartel agreement among the bankers to restrict the amount of credit available by insisting that they all earn a very high income. And if so, it's a standard market failure due to monopoly power.
I'm not sure I agree with your interpretation, because here the banks individually, the banks would like to grow bigger because they would get higher. So B is a given parameter, and they want to go bigger in order to get more return on equity. So
It's like I look at that last equation, and it's like the bankers get together and they realize they all want to go as big as possible. But if they grew as big as they could unconstrained, they wouldn't be that profitable in industry. But to make it profitable, they say we're going to insist that we all get an income B, and then everybody says, okay, subject to that constraint, I'll go grow as big as possible. But that's not as big as I would be otherwise. I think that's what that equation says. Maybe it says the opposite, and I've got everything.
I have to think about that. But one of the results will be that effectively the bankers benefit from regulation because it's a kind of coordination device that allows them to lend more. So I'm not sure it fits with your
I don't know that they
interpretation.
benefit at all, because you could think of the B as being like a monopoly price.
No, I understand what you're saying, but okay, maybe we can talk about it later, but I'm not sure that I agree with your interpretation. So you have a demand for capital, how big the bank wants to be as a function of the price of capital, and there is a supply of capital, which is determined by the marginal productivity in the other sector. So if you invert this relation, you have a function S of P that determines how much capital the investors are ready to put in the banking sector as a function of P. And there is a unique competitive equilibrium where supply equals demand. It's very simple. And this is represented here. So, I mean, it cannot be more simple. So the volume of credit at equilibrium is determined by the intersection of supply and demand. And the price of credit, or the price of capital is also there. So first remark is that this difference here, R minus PE, can be interpreted as a credit spread, because R basically is the rate of return on banks' assets, is the kind of, the interest rate on bank loans, let's say. So remember here we don't have any default. For the moment it's entirely deterministic and there are no defaults. The only reason for this difference is the friction, the financial friction, the B. So if B decreases, if there are less friction, or if banks have more capital, or if the return on assets is bigger, the curve, the demand curve, the dotted curve here, moves upwards, and therefore the spread decreases, and we may even reach the first best. The first best is a situation where the marginal productivity of capital is the same in the two sectors. So in the banking sector, or the small businesses is R, in the other sector it's P. So the first best would correspond to a situation where the spread is zero. And this is attainable, actually. You don't need an infinite E to do that. You can attain it. And the higher the financial friction, the more the higher the spread, actually. So you have a very simple comparative statistics result. In particular, you can show that the market-imposed capital ratio, E over K, decreases with R, which is a sort of pro-cyclicality. When things go well, the capital ratio of bank decreases, which is exactly the opposite that regulators want to impose. There is a lot of criticism of the pro-cyclicality of the current system, but maybe pro-cyclicality is a natural thing to have. And here at this stage, there is no market imperfection. That is, a central planner could not improve
But
on
that's
this.
what I don't understand. So here you say there's no default, but then what is the reason behind the fact that, first of all, investors don't lend more than a certain amount to banks, and why do you need this minimal capital?
So one way to see it is a bit like what Pete was saying, is a kind of monopoly power of banks. If you want to, so here, the small businesses are more profitable than the big firms. For the big firm, there is no friction. For the small firm, if you want to lend to small firm, you have to go through banks. And banks have some kind of market power, and they extract a rent. So the rent is basically the reason why you have this spread. So it has nothing to do with the risk premium. It's just a rent. If you have to go through the bank is going to capture some surplus, and therefore it will be less attractive for investors. Yep?
If I understand it correctly, this is just a code going through the middleman. So it's irrelevant that it's a bank, this is just a cost of going to the middleman rather than coming directly.
But a middleman in the financial sector is called a financial intermediary, which is a bank. So I agree with you. Okay, so now things become more interesting because the market, the competitive equilibrium will be inefficient now. And for that we need to introduce a productivity shock. So in the simple version of the model, it's only sectoral productivity shock in the sense that it's only R that is affected. But in the more general version of the model, they could also affect the production function capital F in the other sector. So imagine there are two states of the world. You don't know when you decide on the amount, the return can be high or low. It can be in a boom or in a recession. The expected return, the average return is the same, but RH is bigger than RL. So the first reaction is to say, well, look, we're going to compute the equilibrium in the two states, assuming that banks only use deposits, ex post if you like, that is once they observe the state, they attract deposits, and therefore the equilibrium will be exactly the same as before, only that there will be a different supply function because R will be different in those two states. But it's more, maybe it's simpler and also more interesting, I believe, to assume that banks also have access to derivative instruments. So it means that at date zero, before the state of the world is realized, they can sign contract with investors. I call that contingent capital contract, or it could be swaps, it could be futures market. Since we have only two states, there are many derivatives that can give the same thing, which is basically that you anticipate the typical bank has a certain amount of equity ex ante, but anticipates that in state H, they would like to lend more because loans are more profitable, but they know that they will be limited by depositors, so they need more equity, and they sign a contract with investors where they have more capital in state H in exchange for less capital in state L. So it's a kind of swap, but I prefer to call it a contingent capital. And the only constraint that is faced by investors is this. On average, they want to get the same rate of return that if they were investing directly on the financial markets. So there is a kind of budget constraint of the bank, which is this. Given E, this is the amount of contingent capital that is feasible. But then each bank will form contingent plan, saying in state L I would like to lend KL, in state H I would like to lend KH. The bank recognizes that the depositors will put restriction on leverage, and therefore if they want to lend KS in state S, they will need to have capital, equity capital, ES in state S, and therefore if you plug this into this condition, you find a unique budget, I call that a budget constraint, but it's more an average leverage constraint for the banks. Given your level of equity, E, you're able to adopt contingent lending plans, KS, that satisfy this linear equation. Is that clear? If you have a certain level of equity today, E, you will be able to attain a certain so you have a feasible set, which is basically a line corresponding to this. And here P is the expected price or the futures price of capital. Is that clear? So at date zero, they sign contingent contract so that they can reallocate basically their equity across the two states. And then when the two states realize, they attract deposits and they lend KS. And now it's the kind of optimization problem that I like, but maybe it's a bit too simple for the Newton Institute. You have a linear objective function and a linear constraint. You maximize the expectation of B times the expectation of KS, which is the expected return on equity for the bankers, under a linear constraint. And if we assume that the production function F satisfies Inada's condition, the equilibrium cannot be a corner solution, it has to be in the interior. And so if you want the solution to a linear optimization problem to be interior, it must be that the coefficient of KS in the constraint is proportional to the coefficient of KS in the objective, and therefore that the prices of capital move 1 to 1 with the return on assets. Okay? So the only thing we need to determine is this average or expected price of capital, because once we know P, we know also PS. So the equilibrium is extremely simple here.
I'm sorry, I'm not following something. Maybe a simple way to, how does a linear function satisfy the Anada condition?
No, I was talking of the production function F, capital F, you remember? There is another sector which tells you that the price of capital, P, will be a nonlinear function, F prime of 1 minus K, which is the amount of capital that is left to the other sector.
Okay.
So if
there's no concavity in this sector.
here it's linear, the only concavity in the model is given by the other sector. And if you assume Inada's condition, it means that you cannot have an equilibrium in which all the capital is allocated to one or the other sector. Necessarily, there must be an interior solution. Okay? So,
Okay.
is that clear?
Yeah, I didn't know what you're talking about. Okay.
Maybe I'm going too fast. Okay, so anyway, the only thing to determine is P, the expected level of capital, the expected price of capital. And it's obtained by aggregating the budget constraints of the different banks. Because if we look at it's linear, so we can aggregate that. So at the aggregate level, PE will be replaced by P times capital E. And here we will have something which tells you that this number here is constant. Okay, so I can take it out of the expectation. And therefore, the expected volume of credit has to satisfy this condition. But since KS is equal to the supply function computed at PS, and since PS is given by this, we have a very simple supply and demand condition. It's the same as before, except that you replace the supply of capital by the aggregate or average or expected supply of capital, which takes into account the variation of prices in the two states. And so the only thing you need to determine is the average price, P, and then you have the supply and demand, and you have the same result as before, except that the interpretation is slightly different, because here you have the expected volume of bank credit, and you have the expected price of capital, but basically the idea is the same. Most interesting part being this, necessarily the prices of capital must vary 1-to-1 with the return on assets in this model. So it means that the comparative statics result we had before are still valid, particular the aggregate volume of credit and expected capital price increase with the volume of capital of the bank, and they decrease with the size of the friction. But more importantly, if you measure the volatility of capital price, so it's not really volatility, it's more the coefficient of variation because there are only two states of the world. But if you compare the variation of prices across the two states, PH minus PL, and you divide it by the expected price, so it's a kind of coefficient of variation, or call that volatility by abuse of language, of the prices, and you compare them to the volatility of return on assets, you find that due to the property that prices vary 1-to-1 with the returns, you realize that the denominator are the same, the numerator are the same, sorry. It's only the only difference is the numerator, is the denominator, sorry. So here you divide by P, here you divide by R, and we know that R is bigger than P because there is a spread due to the financial friction. So necessarily there is a multiplier effect. The volatility of capital prices is higher than the volatility of return on assets, and the multiplier, which is P over R, is higher when frictions are more important and when the capital of the banking sector is lower. So in other words, more banking capital or more transparency, a higher E or a lower B, stabilizes the economy. And here there are no banking crises, it's just fluctuations of credit. And
So sorry, can you go back to this spread and this parameter B, because I still don't understand.
Yeah.
So if you, in this model, if you have, say, two banks,
right,
one of them is has a good performance, okay, so the bankers pay themselves more, so higher B in this model. and the other bank has a low performance, so the bankers, take less pay out of the.
But the first bank will have no customers in end. It will be, since it's linear.
Well, it's not clear to me because then in your model the spread will depend on B. So then.
No, but in the model you're describing, one of the banks will be out of business.
Well,
it will not attract depositors, but because they know that the return they will get, it will be lower.
You'd have to build in something where the return is bigger for the bank with higher B or something.
yeah, but here that's what I'm missing because I don't see how you can have this without any reference to, because the B for me should be fixed endogenously due to some
Okay.
good performance. And if you take these two bank examples, it would make more sense for the bank with higher performance, therefore lower spread, to have a higher B, and that's the opposite of the model because
I mean, the simplest way to endogenize and microfound the B is the Moore hazard story a la Holmstrom and Tirol, where you say that the banks can secretly invest the deposits or the money they have in another technology that is less efficient, but that gives a higher private benefit, for
But
example.
you can see it in the other way around. So to generate profits, a more profitable bank will take out more in terms of pay, so higher B.
I didn't think of a model with heterogeneous banks. I mean, I must say that I didn't.
No, I mean, I don't mean you should take heterogeneous banks. I just say if you want to vary the parameters in the model and do a comparative analysis, then it should be the case that if you have, I mean, it seems that B and the spread do not vary in the
in the same direction. I see. Okay, so I suggest I move on. Maybe we can talk about that later because the time is past. So the important thing is that the fact that there is amplification of the prices are more volatile than returns is not necessarily a bad thing. We need to have a welfare analysis, and so this is what I do now. I called a capital allocation K equals KLKH. That is the aggregate allocation of capital in the two states of the world. I call it constraint efficient if it maximizes social surplus, social welfare, expected output, under the two conditions that investors are ready to put their money in the bank, and also investors, maybe the same, are ready to provide this contingent capital contract to the banks. So these two conditions, in fact, can be aggregated into the kind of aggregate leverage constraint, if you like, of the banking sector. If the total capitalization of the banking sector is E, what is accessible to the central planner is the same as what is accessible to the market, which is this expected leverage or this this average leverage. I don't know to call it. But the important thing is that, of course, we have to assume that the social planner cannot do things that the market cannot do. Otherwise, you could completely eliminate the inefficiency. So we take restrictions on the tools that are available to the social planner. And here, social planner has to be interpreted as a bank regulator. The bank regulator is able to influence the choice of assets by the banks, but is not able to tax or subsidize investments. And then what is interesting is that this is the main result, is that the competitive allocation is constraint inefficient. If you assume on top of that the capital supply function is log concave, which is not a very restrictive assumption, you know the direction of improvement. You know that if you want to improve welfare relative to the competitive equilibrium, you want to restrict lending in the good state and increase lending in the bad state. And I'll say in a few minutes, if I have time, how you can do that. Okay. So what's the intuition for that? Well, it's really the pecuniary externalities that Pete was anticipating here. This represents the maximum welfare expected output under the constraint that the average leverage, aggregate leverage constraint faced by banks, taking as given the capital prices. This is what the market does. The market takes prices as given and allocates capital in a way that maximizes welfare under this constraint. But this is not optimal. Why not? Because the central planner recognizes that the price of capital in the two states is endogenous. And it's not a constant, it's not PS, but it's a function of KS. So if the central planner recognizes the impact of capital allocation on prices of capital, the feasible set has a different shape. And under the log concavity assumption, the intersection of the two, so basically the competitive equilibrium is the intersection of the two feasible sets, the one taken by the market and the one taken by the central planner. And the log concavity means that the intersection, they cross in that direction. So you can improve welfare by increasing lending during recessions and decreasing lending during booms. So basically the intuition for that is that by reducing bank lending during booms, the central planner allows banks to free capital that can be reallocated to the bad outcome and convincing depositor to invest, to provide more deposits, more money in the bad state because there is more capital, and this increases aggregate welfare. So it's not obvious because it has to do with the elasticity of the supply of capital, but in the case where it's supply of capital is log concave, this works. Okay, so there is an externality here, which is related to the fact that banks do not internalize the impact that their decisions have on prices. Even if the banks are small, they all take the same decision because they have the same exposures to macro shocks, and therefore collectively they have an impact on prices. Okay, so it has really to do with systemic risk or systematic risk. So now, in the 2 minutes remaining, let me try to show you how this can be implemented by a countercyclical capital ratio. So suppose that the regulator imposes a limit to bank lending only in a good state. So on top of the leverage constraint imposed by the market, which is an average constraint over the two states, and which is represented by this line here, on top of that, you put a cap on what can be invested or lent in the good state. So the feasible set for the bank becomes this set here. And if you choose the parameters well, the banks will maximize profit by choosing the corner here. And the corner here corresponds to the optimum, the social optimum, constraint optimum. Of course, in a more general model, and I don't have the time to present it, but it turns out that if we maintain the complete market assumption, everything I said is valid for a very general infinite horizon model where you have state-dependent frictions, productivity shocks in both sectors, etc. Basically, the reasoning remains the same. You have a unique linear constraint for the banks. There is a linear objective, and therefore the prices have to match. They have to be such that the interior solution is chosen. And it determines very simply that there is a unique Markov equilibrium where prices only depend on the current state. A priori, they could depend on the whole history, but they only depend on the current state. The spreads are decreasing in S, so there is anti-cyclicality of the spread. Bank lending is pro-cyclical, it's also Markovian, etc., etc. And second result, when bank capital is not too large, because otherwise you can get the first best. So if bank capital is not too large, competitive equilibrium is generically constraint inefficient, and counter-cyclical capital ratio, capital regulation can improve welfare. So if I can have maybe 2 more minutes, I would like to discuss a final thing, which is again a comparison with the debt deflation model a la Kiyotaki, Moore, Bernanke, and Gertler. So I believe that, and maybe this is, I can use this picture here, where you have the markets, banks, and the firms. So basically, Kiyotaki and Moore and Bernanke Gertler focus on the friction here, that is, the borrowing capacity of firms is limited, for example, by their limited amount of collateral, and they focus on this relation. And we focus on this relation, the friction, the limit to the leverage of banks, which are due to the imperfections at this stage. And because the reason is we focus on bank capital, and bank capital matters only in determining the capacity of banks to lend to the private sector. So the assumption that Kiyotaki, Moore, and Bernanke-Gertler make fit well this friction here, the friction between small borrowers and banks. Why is that? Because they assume, for example, that the borrowers are credit constrained only in bad times. When they are in good times, they have enough collateral, they are not credit constrained. It's only in bad times. The other thing is that the credit limit, how much they can borrow, only depends on the value of their collateral. And the reason is they cannot pledge their future income at all. They can only give their collateral. So the value of this collateral determines how much they can borrow. And finally, it is crucial to assume that they cannot access derivative markets, because if they could, it would insure against the fluctuations of the price of collateral, and the inefficiency would disappear. By contrast, we look at different things, the impact of bank capital on macro variables. So we focus on the bank investors relation here. And there, we make different assumptions. In our model, for example, banks are always credit constrained. I mean, of course, it's an extreme behavior, but they always want to be as big as possible because their profit are proportional to their size. So they always go to the maximum leverage, even in good state. The other thing is that the credit limit, how much they can lend, depends on their equity. It does not depend on their collateral, which is part of their assets, like for small firms, but it depends on equity, which is a measure of their future income. And the reason is that there is a legal system that protects investors and that guarantees that if the bank defaults, which is not captured in our model, but there is a possibility for investor to recoup some of the money, okay? So it's a different thing, and in particular, the fact that banks have access to derivative markets in our model does not prevent at all the fluctuations. On the contrary, not really on the contrary, but it's much simpler to analyze the model under complete markets. And even with complete markets, you have something that is, inefficient and that justifies public intervention. Okay, and the final thing, if I may, is that in the model à la Kiyotaki and Moore, Bernanke-Gertler, you can explain credit booms, credit crunches, but you cannot really explain credit booms. To explain credit booms, the fact that they lend too much during booms, which is what we have here, is due to irrationality or expectation of future bailouts or this kind of things. Here, it's perfectly symmetric. The same externality explains both the credit booms and the credit crunches. Okay, I stop here. Sorry, it was a bit long. Thank you very much. Thank you.
Can we ask a question?
Sure, with pleasure.
So if we interpret B as like a labor union that accountants belong to who work for banks or own banks or something like that, then basically what the model is saying is that in the process of charging the monopoly rents for performing accounting services, they're really taxing both the lending in good time sector and the lending in bad time sector. But the tax that they're imposing on the bad time sector is higher than the tax they're imposing on the good time sector.
Yep.
And that creates, that's a standard market failure, and one way to fix it would be to break up the union, but if you're not going to do that, then you take some other policy that would stimulate lending in bad times at the cost of lending in good times, because you want to affect the overall constraints operating in the economy. And that seems to be the story.
Yeah, exactly. That's a good story. And in fact, it's very similar to what Stiglitz and his co-authors have developed in the 80s, where they had these pecuniary externalities. For example, if you have imperfection in the labor market, so these kind of things. So you have pecuniary externalities. But the interesting thing is that if you only have one market, the fact that you have an externality does not prevent the equilibrium to be constraint efficient, because there is no leeway, there is only supply and demand. Whereas if you have two markets, the allocation of the goods between the two markets may be, not always, but may be distorted by the friction.
Okay, but a pecuniary externality is not an externality in that sense. Like a pecuniary externality is not going to create an inefficiency. It might create a distribution of wealth or something you don't like, but it's
but here, in the classical competitive market, pecuniary externality does not create any inefficiency. But here it does. Here it does, because the competitive equilibrium is not constraint efficient. And it has to do with the fact that the prices are there in the leverage constraint of the bank. So if you impact prices, you change the leverage constraint of the bank.
You're talking about a increase of social surplus. Is it Pareto improvement?
No,
Banks
I
are
mean,
worse off, right?
it turns out that yeah, it's not a Pareto improvement. No.
If you think of this,
Sounds like a redistribution.
Yeah, it's a bit like a redistribution.
Lump sum taxes that can make everybody better off, but lump sum taxes don't fix the inefficiency.
if you think of this parameter B as a banker's bonus,
Yes?
then you would naturally have a lower B in the bad state.
No, but this is we can extend that. You can have a B that depends on the state.
And that doesn't change.
No. There are restrictions. I forgot. Basically, you need. It's a question of the ratio of B over R. So you need BS over RS to be higher in booms. The fraction of the returns that the lower in booms. The bankers can extract relatively more surplus in a bad state. This is the sum.
So
Yeah.
it's the opposite.
Sorry, I said the opposite. Yeah. So you need, if you like, if B is constant.
Yeah, because if you have B, which is lower in the bad state, this is like a counter-cyclical mechanism. Right?
No, but you have to remember that B.
It's like relaxing the leverage constraint in the bad state. So this is exactly a counter-cyclical.
This is a moral hazard thing. You might think it went the other way. In the bad state, it's more work to figure out what's going on
Yeah.
and to do the monitoring.
Yeah. The kind of verification cost, or yeah. But remember that we measure B in proportion to the size, to the volume of assets, not to the return. So it's not B times R, it's B. BK, if you like, and not BRK.
I think what Phil is saying, what I'm saying, it really depends on whether you understand B as a true monitoring cost. So we say bankers actually charge proportionally to what.
No, it shouldn't be interpreted as a monitoring cost.
Or, so that's what would make it harder in the bad state, but I'm thinking more of it as a bonus.
Yeah, it's more a bonus than a monitoring cost. You could have a monitoring.
Because you're including it in aggregate welfare. The
Yeah.
surplus.
Yeah. I mean,
It could be a cost to the bank.
yeah, that's right.
To somebody else.
That's right. But then I have to think more of the interpretation of the result.
Because if you look
Is that B times K being paid out to the shareholders of the bank then?
Yes.
So the shareholders of the bank have the option they could invest in the large firms, couldn't they?
Actually, no. I mean, it's not their interest because the return on equity is always bigger than the return on bonds. Because the banks, if you like, banks have a market power here. They are the only ones to channel credit to the small firm, and they extract surplus and the return on equity. So the bankers, for example, never want to put their money into the bond market. They prefer to keep it in the bank because the return is bigger.
But the bank is owned by its shareholders.
Sorry, the bankers are shareholders. Yeah, sure, shareholders.
So
But
the
I mean,
shareholders-
you have to think. One of the
Shareholders have the option to invest in the bank shares or in the large sector.
yeah, but they don't want to do it because the return are higher in the bank shares.
Why would
And so
why would
they
anybody invest in the large sector then?
because the assumption is that it's inside equity in a way. In order to invest in the bank shares, you have to be an expert. Otherwise, you don't understand what the banks are doing with your money. So, I mean, it's one of the limitations of the model. E is really inside equity. And I'm not sure we have a good theory of outside equity.
Yeah, I don't think these can be corporations. These are private banks. These are privately owned banks.
No, you're right. It's
And the people who privately own banks, the people who know how to monitor.
yeah, it's partnership or small investment banks.
Very
No, I agree. It's a limitation.
Useful models are always much separate in the world.
tractable model.
It's tractable, but
Useful models.
okay. Thank you very much.
Thank you.